Good morning and welcome to Bazaar Morning Call. I am Anuj, with me Prashant and Sonia as always, and well, we are looking at a wonderful screen for the global markets. Not that as it matters to India, but it's only a bonus. And the global markets go down, our markets go up. Global markets go up, our markets go up even more. So what more can you ask for? The US market, of course, ended at the highs after starting with big cuts. So big intraday rally in the US market. And of course, the Indian market has ignored the negative global cues, but it participates on the upside on positive cues. The Nifty will test that trend line once again. So that's going to be important. And the big question is, not today, of course, but going forward, can this 18,000 mark be conclusively broken? The SGX Nifty is indicating a big gap up. 150-point gap up is as big as they come. Prashant, Sonia, hi, good morning.
Hi, Anuj, morning. Hi,
Good
Prashant,
morning.
morning.
Best of both worlds, right? Ignore the downside and participate on the upside.
Participate on the upside. And yesterday, the market recouped its losses, and how, right? I mean, financials were leading from the front, autos, FMCGs gains. So I guess this buy on dips philosophy is something that continues through the course of this year. But having said that, it is a strong global market. No two ways about that. Good going on the Dow. The US Fed meet kicks off today. So like a broken record, we're going to tell you that 75 basis points rate hike perhaps is already priced in. 100 basis points is something that the street is bracing themselves for. The 10-year yield ended at 3.5%, which is the highest since 2011. But I want to talk a little bit about what's happening on the corporate side of the U.S. because, a couple of days ago, you heard from the FedEx CEO where he spoke about how there are concerns with regards to recovery, growth, etc. The latest now is what's happened with Ford. The shares were down about 4.5% in after hours, where the management said that the supply chain issues that they faced will cost an extra $1 billion in this quarter. So there are definitely concerns that corporate USA is facing, and don't lose sight of that. For our own markets, of course, things have all been hunky-dory. Yesterday, the FIs bought about 300 crores. DIs sold a tad bit. The next 2 days, the next 48 hours could be, a bit of ebbs and flows, given that we have a big event upon us. But give and take everything, this has been a rising market, and there's no two ways about that.
In this market has rewarded you for not doing anything. If you're tempted by every small move here and there, then you may have lost money, actually. And if you're just done the simple thing of buying and sitting tight, I think this market would have really handsomely rewarded you. So, yeah, I think for me, the big data point is the FII data in the futures and options market. This is something I've been talking about for the last 2 or 3 weeks, that, you have a lot of shorts in the system, and these shorts are just not getting any follow through. So, do they throw in the towel? I think yesterday was the first sign that these shorts have said, okay, enough is enough. We are not getting any traction. Let's just get out of them. Yesterday, in fact, if you look at the longs and shorts, FIs have covered shorts by almost 13,000 contracts. Why is that important? Because the net short is now down to 45,000 contracts, which is still on the short side, but almost half of peak. Now, let's see if, they're still at 68% short position. So, at some point, maybe even this has to cover if the market keeps going up. And X of IT, the Indian market is at all-time high. I mean, if you look at the bank Nifty, that's at all-time high. Auto index is at all-time high. FMCG index is at all-time high. You've seen what cement has done in this market, what infrastructure has done in this market, all of them at all-time high. The only logical trade in this market is buy the dip, but in the economy-facing stocks. IT rallies will be tempting, will look good, maybe like today, but while they'll be powerful, they'll be short-lived, because this is a market in which there's pain in the US, but domestically things are looking quite good. The only risk that I see, Sonia, not in the near term, but in the medium term, is if we keep ignoring this global risk off, and if we keep ignoring recession fears in the US, because at the end of the day, if our IT companies get hurt, that also impacts our macro in terms of balance of payment, in terms of our reserves. So I think that is not in the near term, but in the medium term, that will emerge as a bit of an issue. But just one last point for day traders: 5-day and 10-day exponential moving average 17,725 and 1750. That's the range that I'm working with. If we start to trade above that, then maybe more short covering. Prashant, hi, you got your glasses back.
I have my glasses back. Well, purely ornamental.
So that you can finally read through the US Fed speech. You're prepping yourself for that?
That's tomorrow. That's going to be tomorrow, Thursday morning, right? Yeah. So Thursday, that's Thursday morning for us. But, anyway, the point is that the global is starting to matter lesser and lesser. Now, I don't know if it's a good thing, it's a bad thing, but that's the way it is. The rally in the US basically overnight came in the last 30 minutes or so. I mean, it was a sharp move higher, and it was led by large cap mega tech names, right? So the Nasdaq, for example, did better than the S&P. It was up 0.76%, and the S&P was up 0.7%. What kind of caused this rally? You can't obviously pinpoint on any given day, this is it, what caused the rally. But there was a Bloomberg News report which basically said that in August, housing demand in the US perhaps is it fell sharply. Now, housing is one of the first indicators, or at least a very important indicator to signal whether the economy is doing very well or it's slumping, right? And on the back of this, expectations that maybe the Fed will not be as hawkish as what it told us during Jackson Hole, that 7-8 minute speech. I mean, I think that came to the forefront. So this is, I mean, arguably, if you want one data point, what caused that last 30-minute flourish in the US. And as a result of that, I already indicated what equities did. Yields, which were the 2-year, for example, had spent bulk of the day above 4%. It came off under 4%. It's about 3.95 or so. The 10-year, which was above 3.5%, it finally left off at about 3.5%, just under 3.5%. The DXY index, which spent a lot of time above 110, it fell to about 109.6 or so. So all of this happened in fast-forward mode in the last 30-40 minutes of trade. But post-close, post-US close, you had this from the Wall Street Journal. The Wall Street Journal, the economics reporter, is called sometimes as the Fed whisperer. And he wrote an article and he pushed quite strongly against any potential dovish outcome in his article. This came out post-New York close, post-NYSE close. So keep that in mind. I mean, I probably would have put some of the stuff what he said. He said he quotes Powell and says the clock is ticking. If you let inflation run high, households are going to adjust to these high levels of inflation and start to act accordingly. We don't want that. We want to avoid that outcome. So the clock is ticking. So, I mean, this happened post-close. The point is, I mean, if this was a regular kind of market where global cues mattered, and right now they don't, I would have been very surprised to see the SGX indicating the kind of opening it is indicating, or the bulk of Asia, which is, I think, in the green, not wildly or anything, but there's more green than red. This would have mattered. For now, I mean, this is not. That's where we are at right now. SGX indicating a 150-odd point higher start. We'll pick up from there. And that trend line that Anuj spoke about from the all-time high, October 2021, all-time high of 18,604. I mean, I think there's going to be a knock of that once again. Sonia.
Oh, absolutely. And we should keep the cautious points also in mind, right? I mean, a lot of stock market bears in the US are eyeing the June lows post the Fed meeting as well. So don't lose sight of that. Of course, our own markets have been very, very resilient, but there are challenges on the horizon and you shouldn't lose sight of that. I think the 3,900 mark on the S&P 500 is being watched very closely. Let's do one thing. For now, at least, the going is extremely good. And let's tell you what's happening in the other market, which is the money market. The rupee has been fairly resilient in the last few days. Bhaskar Panda of HDFC Bank says that there is a lull in the markets ahead of the US Fed policy announcement. He says that the dollar index has been moving sideways while oil prices remain slightly biddish for fear of the OPEC plus action. He says Japanese CPI comes higher than the Bank of Japan's comfort zone. On the domestic front, he says the dollar INR pair has been sandwiched in a narrow range as 80 mark remains protected more or less. Given this background, he expects the dollar INR pair to trade in a range of 79.70 to 79.90 for the day.
Okay, and on the bonds, we have Bhaskar Panda who says that the Indian bond market yields have been rising slowly on the back of impending global as well as local central bank action. He expects the 10-year benchmark bond yield to consolidate within a range of 7.25 to 7.3% for the day.
All right, we've got a very special voice now joining us to take us through and make sense of all that is happening globally. James Sullivan is Managing Director, Asia Pacific Equities Research at JPMorgan, and he's joining us from the sidelines of the JPMorgan India Investor Summit. James, it's a pleasure. Great to have you with us here on the channel, on the program. As always, a pleasure is ours. So make sense to us, and I'm assuming that you will get this question from investors, etc. You meet as well, to explain this huge outperformance we are seeing, right? That word decoupling is back in vogue. How do you explain it?
First off, thanks very much for having me on the program. It's fantastic to be with you today and talking about the Indian market. To answer your question, I would approach it from two distinct directions. One, from a broader markets perspective, Two, from a microeconomic perspective. From a markets perspective, I think it's important to recognize the special place that the Indian market exists within global markets right now. It's one of the only major liquid markets where we expect GDP growth in excess of 7%. And the gap of economic growth in India relative to near-peer competitors such as China is the highest it's been on record. And so when we talk about the fact that valuation is very high, there is a reason for that. This type of economic growth is extremely scarce in global markets. You're seeing a significant investor rotation away from the very heavy index constituents in emerging markets, and in particular China, and towards not only India, but also the ASEAN markets, which are ultimately the outperformers on a year-to-date basis. So from a broader economic growth and asset allocation perspective, you're seeing very significant interest in India. And I would suggest that that's not over. You've actually seen net foreign outflows from India on a year-to-date basis, despite the near-term strength that we've seen in some of the inflows over the course of the past 30 to 60 days. So that's a very interesting backdrop. From a micro perspective, one statistic that I find fascinating, if I look at what a corporate would spend to borrow money in India, depending on the corporate, you're looking at somewhere between 12 to 14%, and overall loan growth is averaging around 11% in the Indian economy. In China right now, the average corporate would borrow somewhere between 4 to 5%, and loan growth is almost the exact same level and falling significantly. China loan growth is down roughly 30% on a year-on-year basis. India is almost doubled, despite the fact that you're spending three times as much to borrow that money. I think it speaks to the very significant interest that investors have, both public market as well as private corporates, in the Indian economy. And we've obviously seen all the headlines in terms of large Indian corporates reinvesting in India in a way they haven't in close to 50 years. So there's lots of reasons to be very interested in the Indian market right now, which is one of the reasons why we think the JPMorgan Investor Summit is well-timed.
Okay. James, hi, good morning. Yeah, it couldn't have been timed better, right? Our market is very close to all-time highs. One thing which stands out is that in India, the domestic economy-facing stocks are doing the best, while the export-oriented stocks have taken a bit of a backseat, which is what had led the rally in the first place. Do you think this trend would continue?
So I do think it makes sense. If I look at the sectors that were overweight from the JPMorgan's perspective, we're overweight the financial sector on rising net interest income, as well as overall loan growth that we think will outperform the rest of the region. We're overweight the staples space. Again, the key scarcity that we're seeing in global emerging markets right now is macroeconomic growth. In India, absolutely shines from that perspective, with overall macroeconomic growth forecasted over 7%. And again, it's the relative conversation there. As China dips to closer to 3% this year, and perhaps having a 4 handle on the front of that number as we look forward into 2023, India is very differentiated. And so we do think the strength of the domestic economy is justifiably driving sector-level outperformance, particularly if the forecast is more of a global economic slowdown. At JPMorgan, we're forecasting the Fed rate to hit 4.5% next year, which is in line with the most recent Fed dots. We're expecting 75 basis points this week, as are most market participants, as are rate markets. Overall, we think central banks in developed markets will continue to have to be aggressive into 2023 in a way that's perhaps not fully priced into rate markets for longer duration bonds.
James, good morning, and good to see that you're in India. I want to ask you a little more about the Indian markets, but before that, do you reckon that the US markets could retest the June lows post the Fed meeting? I ask because the data points from corporate USA is not looking too good, right? I mean, we just heard from Ford, where they have talked about how supply-side issues are causing them to see a $1 billion loss. And then a couple of days ago, you heard about FedEx closing multiple locations, delaying hiring. All of this, do you think, could drag down the U.S. markets through the course of the next few months?
So on the negative side, very clearly you're seeing pressure on corporate profitability because of rising wages, because of some of the supply side issues driving up input costs across corporate America. What I would say from a broader markets perspective that is interesting, at least for the first time this year, you've seen rates arguably fully priced in as we go into a Fed announcement, with the markets generally looking at a 75 basis point increase this time around. I don't feel as though that rate markets are fully pricing in 2023, as we had just discussed. But for this year, you're aligning expectations versus reality, perhaps in a better way than we've seen for some time. You add to that the market downturn that we've seen across a number of very large sectors, and I think we're pricing in a baseline from which we can work from. But there's still very clear significant risks, particularly on the cost side, as we enter 2023.
Just a quick point. I mean, some of the points that you made are very interesting. Asset allocation, scarcity of growth, large liquid market offering this kind of growth, etc. But does it also then risk creating an unnatural kind of a environment where money is going in because that's the only game in town and pushing things higher? And we can keep explaining it with, of course, the lack of growth elsewhere. But is it unnatural, or you think, it can go on for a long time?
It definitely creates the opportunity for valuation overreach, and that's something that we're watching very carefully. And one of our arguments, not shocking for a bottoms-up equity person to say this, but one of our arguments is that sector and stock selection is absolutely critical in this overall conversation. And I think one of the ways that we'll see investors make significant outsized returns this year is correctly understanding the sector rotation that we expect to see. To your point, you will see funds flow that is perhaps more aggressive than we've seen historically, that will find its way and potentially overinflate certain sectors. And understanding what's in the price is always important, but it's even more so in an environment like we're currently seeing, where you're seeing this very aggressive rotation of funds out of large countries in Asia and into markets like India.
James, there's one theory that I read this morning that perhaps now is time to shift from equities to bond markets, because perhaps the bond market is giving better value for money right now. Would you agree with that view?
I think the easiest way to try to quantify that is to look at the dividend yield or the earnings yield, which is the reciprocal of the price to earnings statistic, relative to bond yields that we're currently seeing. The one thing that would make me concerned on that trade is, as we've just discussed, I do believe that rate markets and bond markets still have to price in more aggressive, particularly developed market central banks as we look forward into next year. Median Fed dots are at 4.5% Fed funds rate middle of next year. Rate markets are not quite there yet. And so as we price that in, you could set the stage for a rotational trade across asset classes out of equities and into bonds. I don't think we've fully priced in the level of aggression that we're likely to see from large central banks around the world. One of the things that we're now starting to see developed market central banks respond to, and we think India will be at pace with this, with a 50 basis point increase rather than the 35 basis point rate increase that we had penciled in India, is the fact that the Fed aggressiveness is leading to very significant dollar strength globally. Emerging market central banks are going to have to respond to that. So you put all that together, and I do think there will be a time for that trade. I don't think that aggressive central bank impulse is fully priced into rate markets at this stage. Okay.
Talking a little more about India, I was going through your overweight calls, and you have a large exposure in the financial space, whether it's SBI, ICICI Bank. Of course, that space has done exceptionally well. Credit growth has picked up, especially corporate credit growth. Is this a sectoral call for you? Do you prefer financials over, say, other large caps like IT, especially in the Indian markets?
I think that's fair. And as we've discussed, despite the fact that corporates are borrowing at mid-teens interest rates in India, we're still seeing acceleration of overall loan growth and loan demand. And again, the headlines, I think, are undeniable in terms of the large Indian corporates reinvesting in India in a way we haven't seen in close to half a century. So you put all that together with the 7% plus overall GDP growth, and we see a very conducive environment for private sector investment, inclusive of large Indian corporates, which are supportive of the overall financial industry. You add to that the fact that you get a little bit more leeway in terms of pricing of debt in a rising rate environment. The impact of net interest income is quite positive. And so we do think it's right to be overweight the sector relative to other spaces in India. The other sector that we're relatively positive on is the staples space, largely because of exposure to commodities.
Financials and staples are the two overweight areas for you?
That's correct. Financials and staples, currently underweight discretionary. We are looking very closely, however, at rural income levels off the back of rising agricultural prices. The index is still up about 8 to 9% year to date, despite the recent drawdown in food prices. The JPMorgan view is that you do see structural deficit in both overall energy markets as well as food markets on a structural basis over the course of the next couple of years. And so we do think we'll see a very strong impulse for rural incomes in India as well as other regional economies, particularly across the ASEAN space.
James, I know it's a different team, the JPMorgan Index team. I put out a piece essentially kind of just highlighting the fact that there is a lot of interest and chatter around the fact that the Indian government bond market may be made part of the global bond indexes. It's a long time coming, and now finally investors are asking for it. Essentially because of some of the reasons that you highlighted, that there are Russia, for example, went out of these indices in March of this year. Any thoughts at all whether it could happen this time? I mean, the review happens and a decision usually is announced in September, early October.
As you highlighted, different team and far above my pay grade, unfortunately. What I would highlight, however, is it really touches on a very important theme for India as a country and the overall Indian equity market, which are the number of incremental steps that the government can take to really supercharge growth across the Indian economy. If it does get included, the impact on cost of funding will be meaningful, and projects that were previously uneconomic will become very, very attractive. That is a boost to economic growth. Some of the experiments that the government has put through to reduce particularly frictions for intrastate trade, I think, are absolutely fascinating from a macroeconomic perspective. And so what I would suggest is overall it touches on the idea that the government has a lot of levers yet to pull to push growth in India.
All right. Well, that seems to be the overarching theme, that India is bulletproof and continues to remain so in this challenging global environment. James, always a pleasure speaking to you, and all the best for the conference. We hope to hear from you soon on what the key takeaways were. Well, that's JPMorgan. They have an India Investor Summit underway, and very interesting takeaways coming in from there so far, at least. But let's give you some more views on the equities front. What can you expect as we head into the big global event? Chetan Seth of Nomura says higher oil prices is a risk to watch for Indian equities, while lower commodities ex-energy is a risk for crowded Indonesian equities. In general, he says low emerging market allocations and moderate foreign investor positioning provide some buffer for Asian stocks if global stocks remain soft due to policy tightening and recession concerns. Let's take a quick break on that note. On the other side, our list of top 10 stocks is lined up with our entire research team. Do stay tuned in. Welcome back to Bazaar Morning Call. Just trying to assess what the morning could look like. It looks like it's going to be really good. The SGX Nifty now is up about 149 points. Now, the market yesterday recouped its losses. Financials were gaining quite a bit by the end of trade. So let's see how today shapes up. Our research team is here to help you with the list of top 10 stocks. Let's get straight down to that. Anuj, what are you looking at today?
You know, Sonia, there's a reason I keep repeating the same 2 or 3 stocks. I was discussing it in the editors roundtable as well 2 weeks back, the kind of FI money which is chasing stocks. So, look at SBI and ICICI Bank. I know, this is the point about not doing anything in the market once you get into a winner. Because just, these stocks keep making highs, and SBI is close to lifetime high. ICICI Bank is almost there. So, till the time the market gives you, a caution sign, I think these are the kind of stocks which will continue to do well. But, yesterday in closing bell, we were wondering what was going on in Canfin Homes. There was a lot of buzz, chatter, in the market groups about, the resignation of the Canfin Homes CEO, and it, came out like that post the market close. Obviously, someone new in the market because the way the stock declined 7%. But Abhishek, tell us what exactly happened.
Well, Anuj, as you mentioned, MD and CEO of Canfin Homes, Mr. Girish Koski, has resigned from his post. So he'll be discharged of his duties in the near term. There is no definitive timeline has been given now. However, just to alert our viewers, his term was to end in September of 2024. So Jefferies has written a note on Canfin Homes. They have a buy rating over there with a target price of 730 per share. They say that the uncertainty around management transition is an overhang in the near term. So Mr. Kosky's resignation is a setback. Canfin Homes has been delivering on growth, profitability and asset quality as per Jeffrey's note. External CEO from industry may be viewed favorably by the investors. However, uncertainty around upcoming management change would be an overhang on the stock in the near term. So this resignation, as you mentioned, has come in as a negative surprise. There were shorts built in the system, so the stock may open on the lower side, but how it trades going ahead will depend on the short covering factor as well. Back to you.
Okay, and I guess we all know that Girish Kosky in his tenure has had a very strong track record, right? Despite COVID, there was a very healthy growth that came through from Canfin Homes, one of the best in the business. Of course, people come and people go, but definitely there's going to be an overhang on the stock.
The other thing, just the stock movement, right? It's just crazy. The news came after close because we were on till 3:30, the closing bell, and the stock collapsed at around 132 or so. So this obviously was, and this stock specifically, there is so much back and forth and so much speculative activity which happens. I mean, I'm just amazed.
I think this is a fit case for investigation. I mean, and it will be easy, I guess, if you do it, because the way it collapsed. These things happen in the market. The risk here, though, about Canfin Homes, Sonia, and while I do take your point, is that it's a stock which is owned by institutions. Yes. I think this morning you might have some short covering because again people took home some short positions yesterday. But after that, if there's a rally, would that rally be suspect? Because you don't know whether when the new CEO comes in, whether there's going to be some kitchen sinking or not, which happens in the financial names. So that I think would be the risk. For the day, of course, anything can happen. But I think this is really curious the way the stock collapses.
Absolutely curious, and you don't know who the new CEO is going to be, right? His predecessors were generally from the parent, Canara Bank, but if they get an external CEO from the industry, then maybe that may be viewed favorably. You never know. I mean, in any case, just look at last 1 or 2 years. In just the 3 months, I mean, look at Canfin Homes' performance, 40%. So let's see how things go.
The other thing is I remember asking this to Canara Bank CEO, CMD, who was on the channel, whether there was some kind of irregularity in the Canfin Homes balance sheet or some kind of fraud amount. And I think he had mentioned that was a very small amount. Now, I mean, I don't know, as I said, when the new CEO and MD comes in, I don't know if there's going to be re-inspection of books and all. But these are things which sort of vitiate the environment a bit. So I guess it's a stock where you might see some volatility going forward.
Okay, some volatility for sure, but that will definitely be one of the stocks on our radar today. Let's move on. Ekta is sitting by to tell us about Natco and Kim's and why she's watching that one. Ekta, morning.
Hi, thanks for that. Well, for Natco, it's an interesting piece of news because they've got the nod from the Delhi High Court to launch CTPR, which is basically an insecticide. They have forayed into agrochemicals around 2 years ago. Now, Natco was engaged in a legal battle with regards to the use of CTPR. Natco was sued for the process patent, and they had indicated to the court that they have a non-infringing process. So what this means is that basically they will be able to launch the product shortly in the Indian market. And to give you some perspective, the current market size of CTPR, this particular insecticide, is around 2,000 crores in the Indian market. So it's definitely going to be a big kicker for them. Remember, agrochemicals is only less than 1% of their sales at this point in time, but CTPR going forward could be more than 10% of their whole agrochemical business. Lastly, Kim's is in focus because there was a further stake sale by General Atlantic. They sold around 12.1 lakh shares. The buyer is ICICI Pru Life Insurance. Maybe we could see some red on Kim's today.
Ekta, thank you very much for that. So Kim's in focus as well. Now more stocks with news flow. Mangalam is standing by with that list. Mangalam, hi, morning.
Good morning. So we'll start with CG Consumer as well as Butterfly Gandhimati. Now CG Consumer has approved the sale of 6% stake in Butterfly Gandhimati via an offer for sale, and this is done basically to meet the minimum public shareholding norms. After the acquisition of the company and the open offer, now CG Power, who are promoters of the company, own 81%, so they have to bring it down to 75%. I expect Butterfly Gandhimati, however, to be in the red, primarily because the floor price of the OFS is almost at a 9% discount at 1370 versus their current market price at close around 1500 odd. Hatsun Agro is the other stock I'm watching out for. The board has approved a rights issue worth 400 odd crores, so some capital raising coming in out there. And finally, we have a stock, Mishtan Foods, which we usually don't talk about, but the nature of the announcement is such. They will set up a grain-based ethanol plant for a capex of 2,250 odd crores, which can bring them revenues of 3,500 crores by FY25. The important part, however, is as of now, the company's revenues are close to around just 500 crores and the market cap is 1,000 crores. So this is something that we will monitor closely. Interesting development there.
Okay, Mangalam, thanks a lot for that. Mishtan Foods, penny stock, of course, but we'll keep an eye on that. Vivek is joining us for some stocks in news. Vivek?
Well, some positive news flow in some of the stocks we are covering today morning. Ircon International, this particular company, has received an award worth almost 256 crore from Mahanadi Coalfields. Now, the duration of this particular project is around 15 months. The next stock, of course, is Bombay Dyeing. Some fundraising activities being seen on the radar. The board meeting has been kept on September 22nd to consider raising of funds via the right issue. Now, the other one is the Advanced Enzyme. It's a very interesting bulk deal that happened yesterday. A promoter entity, Advanced Vital Enzymes Private Limited, has sold close to 25.7 lakh shares, close to 2.3% of the total equity of the company. And the buyer is a very interesting name. Nalanda India Equity Fund is the purchaser of this particular stake. So it's going to be interesting to see how the market reacts to this particular stake by Nalanda.
Okay, thanks a lot for that, Vivek. So that's a list of top 10 stocks. Here's a quick recap. Stocks with positive news flow. There's Natco Pharma, Crompton, Hatsun Agro, Mishtan Foods, Ircon, Bombay Dyeing and Advanced Enzymes, while stocks with negative news flow, Canfin Homes, Kim's and Butterfly Gandhimati. But let's also get a quick word in on what's happening in the world of crude, because we're heading into a big event, the US Fed meeting. Manisha Gupta is joining in for all the commodity market action overnight. Manisha, good morning.
Morning, Sonia. Well, yes, the U.S. Fed meeting is keeping most of the asset classes under pressure, and definitely the case with commodities, because the U.S. dollar index at a 20-year high does impact the dollar-denominated commodities. For the U.S. crude, it also is about the SPR, or the Strategic Petroleum Reserve, ready to release 10 million barrels yet again into the market. This would only increase supplies, and that's weighing on. And then you have the Chinese crude refiners also increasing exports. There's not so much demand internally, domestically within China, and they are exporting surplus, and that's increasing supplies as well. And then with IEA forecasting a zero demand growth for crude in fourth quarter, has continued to weigh into the markets as well. The only thing that comes in by way of support is the OPEC output, which is short of quota. It was down 2.8 million barrels per day in the month of July and has increased to 3.5 million barrels in the month of August. That is what OPEC is short of the agreed quota that they would produce into the market. That's the only supportive factors. Apart from that, we're looking at pressure not just in crude, but the base metal prices have continued to decline as well. So you have copper trading at a 5-week lows, rubber prices at a 16-month lows, steel prices at a 1-month lows. So many of these industrial commodities are starting yet another day on the weaker side ahead of the US Fed.
Okay, thanks a lot for that. Let's take a quick break. On the other side, plenty of stocks to discuss. Dipan Mehta of Elixir Equities will join in for some fundamental stock analysis. We'll also connect with Prem Kishan Gupta of Gateway Distriparks to discuss the benefits of the National Logistics Policy and an outlook on their business. Do stay tuned in.
Welcome back. Well, the SGX Nifty is indicating that we'll have a big gap up, and this is on top of yesterday's rally. The Nifty was up almost 100 points. And of course, the market's been ignoring weak global cues, but on days of strong global cues, it rises at double the pace. We have Deepan, of course, joining us now. Deepan, good morning. While overall cues look positive, let me start with a stock which has negative news and perhaps could be one of the stocks of the day. Canfin Homes, how do you approach this stock? It's done so well over the last 2 or 3 years, been one of the best-in-class sort of stocks. But given this news flow and uncertainty, would you get out or look to add more on dips?
Good morning, Anuj, and thanks for having me on your show. Yes, I think some amount of uncertainty has crept in, and usually when an NBFC, when the CEO resigns, there's always more trouble to follow. But I think with Canfin Homes, you can take a slightly more optimistic view. The reason for that is that by and large, the lending book of Canfin Homes has been very clean, and they focus mainly on salaried employees. They do not have the issues of builder loans, which some of the other NBFCs have. Valuations are attractive, and overall growth rate over the past few years has been pretty decent. And even when the NBFC crisis was there, Canfin Homes, I think, performed pretty well in terms of raising resources and managing the balance sheet. So I'm not that perturbed unless some fresh adverse news flow comes about the loan book. I'm not that worried about Canfin Homes, and such corrections are good opportunities to get into Canfin Homes. I think it's a good dividend yield. And on the whole, I think a solid company, I think which should do very well going forward.
Okay, solid company and should do well going forward. One of the best in class in its category, right? Dipan, hi, good morning. What are your thoughts on M&M now? Because, we were speaking with Ramdev Agarwal yesterday, and he said that there's a growth bonanza coming into the company, and it's getting rid of all of its legacy businesses, which is, of course, a great thing for shareholders. At this point, is the risk reward still favorable in a name like M&M?
Sonia, all I can say about M&M is that I hope they can give their vehicles quicker to us. We are trying to book some M&M models, and the waiting period is almost 6 months plus. So I think it's a fantastic case for capacity addition, and there's good growth visibility. It has a decent EV strategy as well. And on the whole, I think it seems to be firing on all cylinders. And overall, I think the SUV business, the share of the revenue and the profits are gradually going up. So the cyclicality of the farm equipment will definitely come down. Valuations also have moved up, but I would say that M&M is among the best auto stocks to own at this point of time, given the kind of growth momentum which is there, especially on the back of excellent response which they have received for their models.
Deepan, hi, good morning. Cement, were you surprised by the move? Ambuja ended 10% higher yesterday. And what from here, according to you?
Good morning, Prashant. I think ACC Ambuja are getting the Adani price to earnings multiple. And we all know that all the Adani stocks trade at very rich multiples, irrespective of how the other peer group companies are trading at. And I did see the news about aggressively expanding the capacity. But I think overall, that's not positive news flow for the cement industry per se. There have been periods in the past where excessive capacity buildup has led to a glut. And maybe 3-4 years from now, we are getting into that kind of a situation. But for the time being, I think the market is excited about the capacity growth which comes through and the momentum in terms of earnings which will follow. But let's just wait and watch. It's not that cement stocks are trading at very cheap multiples. Given the kind of profile of the business, the cyclicality which is involved, perhaps inability to pass on cost increases, I'm not that positive on cement at these valuations. So I'd like to, be slightly underweight in the sector as a whole.
Okay, I do want your thoughts on the logistic companies, right? Because the Prime Minister launched the National Logistics Policy on Saturday, and we have a company joining us now. So Dipan, just stay on for a bit. This policy seeks a unified regulatory environment for end-to-end logistics services and an overarching institutional framework that will govern the logistics sector. Prem Kishan Gupta, who's the chairman and managing director at Gateway Distriparks, joins us now to discuss the benefits they expect from the new policy. Mr. Gupta, thanks a lot for joining in. There are several things talked about in this policy, whether it's reducing the cost of logistics, focusing on digitization, multi-modal logistic hubs being made all across India. But from your company perspective, can you tell us what are the key takeaways for you and how could you benefit? Sir, you're on mute. If you could just unmute yourself.
Yes, sorry. Good morning, Sonia, and thank you for having me on the channel. See, as far as our company is concerned, the highlights of the national logistics policy, what has been done in the past and what is going to be in the future means a lot for us. The Western Dedicated Freight Corridor and the Eastern Dedicated Freight Corridor, which are near completion, 70-75% of it is completed. And the government has announced that in the next 12 months, all the 3 ports will be fully functional, on the DFC, that is Nhava Sheva, Pipavav, and Mundra ports. As far as our company is concerned, we already have a location for this double stack movement of containers on the locations that where our ICDs are there. And we have the hub and spoke model. We are already providing the last mile connectivity, which is one of the highlights of the policy. And then bringing all the departments, there are various departments, various ministries involved. Bringing them all on a digital platform will give visibility to the service providers as well as to the end users. And if everything is available on one platform and there will be more spending on the infrastructure in the logistics side, whether it is rail, road, sea, coastal shipping ways, air cargo, all these when they are put on one platform and it is digitized, I think the movement will be faster. We expect a faster implementation of projects not only from the government side but on the private side also, and that will result in a shorter time to ship out the goods both for exporters and even for domestic movement.
So, Mr. Gupta, is there anything in this policy that has been left out? Anything that you think could have been added to make it better?
No, I don't think that there is anything because see, this is the broad framework. The nitty-gritties of the policies will be announced soon. So that time it will be seen what is left out or not. But the broad framework and the various aspects have been covered. And if it is a unified platform and digitized, and the time for sanction and implementation is shortened, the movement of goods will be faster, which will be in the interest of the manufacturers. It will boost up the industrial production. It will be good for service providers to have a faster turnaround. And it will be good for exporters, especially to ship their goods out on time, so that their productivity also increases and the cost of logistics services which are being provided now have different angles: road, land, port, sea. They will have a unified rate and they are going to benefit from that cost.
Okay. For your own business, if you can just leave us with some targets. In FY22, it was a revenue growth of almost 16%. The margins have improved quite a bit. What are you outlining for FY23?
I think we will continue the growth in our existing terminals. In addition, we are very close to, add 2 more terminals in the northern hinterland, and the revenue growth that will add to the revenue growth to the existing terminals, and the margins will expand because once the volumes go up, I mean our overhead costs also come down, and the faster turnaround means the assets are sweating. So I mean we have a lower cost by way of gaining volumes.
Okay. All right. We will leave it at that. Thanks a lot for joining in and giving us an update on the policy itself. Not too much has come out in terms of details, but the overarching theme is they want to bring down logistic costs across the board. So let's see how that shapes up. Dipan Mehta is still sitting by with us. Dipan, this is a space that has done relatively well, but any stocks that you like from a long-term investor standpoint?
So I think the top pick has to be Container Corporation. And if that is getting privatized, then it will mean a big upside for the minority shareholders. And this dedicated freight corridor, I think, is very positive for Concor as well as Gateway Distripark, because that will shift a lot of the cargo from road to rail. And once that is completed, a lot of the movement of goods from the north will go through this dedicated freight corridor, and it's supposed to be more economical in terms of transportation costs, and will certainly provide more volume to Concor as well as Gateway Distripark. So yes, I think generally positive on the sector as a whole. But as I said, the market leader is Concor, and that's where one should stick their investments with.
Market leader is Concor, so perhaps stick to that. Deepan, I've just wanted your thoughts on what's happening with some of these insurance companies, and whether names like HDFC Life and SBI Life, where we saw some buying yesterday after one-way decline. Would you buy any of these names?
See, yesterday I was just going through PB FinTech, and an idea just struck me that rather than buying these insurance companies, which are also quite richly valued, why not give PB FinTech, which is Policy Bazaar, also a chance? I think it's a new age digital business. And the way the revenues have grown over the past few years and the kind of momentum which is there behind, it is highly expected that in a couple of years' time, it will turn very solidly profitable. And therefore, thereafter also the growth will sustain going forward. It's a complete play on all the insurance companies, and all of these companies are there on their platform. It kind of, serves the millennials, which are more focused on buying digital products, especially financial products online. So I'm just thinking that rather than buying the insurance companies, if you have a slightly longer term view, 3 to 5 years type of a view, which is what view you have to take for insurance companies because these are long gestation businesses, maybe one could look at Policy Bazaar and see how that shapes up. Other than that, I think the likes of HDFC Life, ICICI, LIC, they are more or less discovered companies, and they should do well depending upon the growth of the overall industry. But really, I think the surprise mover could be PB Fintech.
The one thing with PB Fintech, I guess the biggest risk is this, the regulator wanting a platform, a creation of a platform for insurance policies to be sold. And that is exactly what PB Fintech is. One doesn't know if that will go through, but the regulator is very keen. Our colleague Yash has, of course, reported on that many times. So that is the single biggest risk if it does come to fruition. Deepan, any thoughts on defense as a space? Again, the rally continues unabated. Bharat Dynamics, HAL are the two names which come to mind, but there are so many others. But these two, of course, recently have been doing much better. Even I heard someone talk about Mazgaon Dock as the next big one to focus on.
Yeah, and you could add Garden Reach also to that list. I think all of them are doing reasonably well. There's good earnings visibility. Again, these are well-discovered stocks, and you will see earnings momentum pick up over the next few quarters as a lot of the disruptions are over and done with, and order book also should start to improve gradually as more and more orders are focused towards domestic manufacturing as compared to imports. So I think this is a good investment theme, and a lot of investors have looked at it positively, and we are also quite optimistic on the prospects of the entire sector per se. The only risk factor is that these are PSU companies, and you could expect some kind of a government interference, maybe in terms of margins or order booking. Or there's always that risk factor as a PSU stock. But apart from that, I think these are good secular growth stories at this point of time. And I think next 3-4 years should be very good for these companies, and they should give at least market or higher than market related returns.
All right, let's do one thing. Plenty of questions to ask you, so just stay on for a bit. We'll take a quick commercial break. Mitesh Thakkar and Sudarshan Sukhani will join in for some technical trades in just a bit. Stay tuned.
Okay, welcome back. Well, we have Sudarshan Sukhani and Mitesh Thakkar now joining us. The market looks like will reward you if you took the long trade yesterday, which is what both Sudarshan and Mitesh have been recommending. Good morning, Sudarshan. That trade's been working out, right? If the Nifty stabilizes around 17,500, buy the Bank Nifty and let it be. Of course, we had a rally yesterday and looks like we'll have a gap up today. What next?
Yeah, good morning, Anuj. See, 17,500 was under test yesterday. The market tried to go down, but there were a significant number of buyers, and the test of holding 17,500 was successful. So usually this test, it lasts for a few days. It doesn't mean that a change of trend has taken place and we are back into a strong bull market. That's not the case. But these short-term tests have some life. So today again, I think we should see reasonably strong markets. Because there is a gap up, it would be wise to wait for a dip or wait for at least a sideways consolidation to go long. And today the opportunity comes in both the Nifty and the Bank Nifty. So the idea would be to go long, keep a 100-point stop loss in the Nifty from the opening price and a 150-point for the bank. I think that stops can be trailed quickly.
Okay. So buy both Nifty and Bank Nifty today, that kind of a day. Of course, put a reasonable stop loss, but don't chase the gap up. Maybe if the market gives you a dip or consolidation, then perhaps you want to buy. Mitesh, good morning. If one were to buy today, what would be the stop loss? Is that advisable in the first place? What's your call?
Good morning, Anuj. Not with the opening gap up, purely because on Friday we had a gap down and that was around the areas of 17,820, 850. So if you open about 130 points higher, you're very close to 17,800, 820 level. So maybe if you get a dip post that, around 45, 50 point kind of a dip, then it would be a good idea to explore longs. Then I think, keep a stop loss at about 17,667, which was yesterday's high. And as long as that has not been taken out, good chance that after that gap, we'll head towards 17,820, 850 odd levels, which is where you would want to take profits on the short-term trading positions. The Bank Nifty, as we have all discussed and we all know and acknowledge that the Bank Nifty is a stronger index, I think that could possibly head towards 41,500 to begin with. And if that is crossed, at 41,800. So I think, I would watch the Bank Nifty closely. Maybe on a breakout above 41,500, the Bank Nifty might offer a better entry point.
All right. How about individual stocks then? What do you think one should be buying and selling today? Mitesh, let me start with you.
Yeah. So on the stock side, I have more of buy calls today, 3 buys to a sell. Bajaj Finance is a buy with a stop below 74.50 for targets of 7,600. Escorts had a very strong breakout yesterday. That's a buy with a stop at 20.50 for targets of 21.65. And HUL is a buy with a stop at 25.54 for targets of 26.30. IEX on the other side is a sell call with a stop at 157.5 for targets of 145.
Okay. And Sudarshan, what are you going with?
I'm going with the same stock, at least one common stock with Mitesh, that's HUL. HUL is a buying opportunity for me also. It's probably completing a correction and likely to move up. Stop is 25.08. Alcom is a buy. Alcom, if you see the chart, the Alcom has been moving up steadily. Even when the market was going down, going through a correction last week, Alcom was very decently up. So that's a buying opportunity. Stop is 3146. Birlasoft, Bsoft is the intraday short sell. Again, it's a very weak stock, at least now. It has poor relative strength, downside momentum. Keep an intraday short, stop above 3311. And finally, Granules is a buy. Granules is another outperforming stock. Keep a stop at 313 and look to buy it.
Right, thanks a lot for that. We'll come back and talk more about technicals. But for now, thank you, gentlemen, for joining in. Let's take a quick break. The pre-opening rates kicking in a bit. Also, we'll connect with Pinakin Parekh of JPMorgan India. He's joining in from the JPMorgan India Investor Summit. He'll talk about the hot sector right now, which is cement. More on that in a bit.